Welcome into another edition of Market Takes. I am Dion, Rabouin, reporter at the Wall Street Journal. Today we are breaking down the latest FOMC meeting, Fed Chair Jerome Powell's press conference, the FOMC statement. We are going to be explaining all things Fed. We're going to walk you through everything you need to know about this Fed meeting that just happened. The chairman came out and spoke. Markets had a big reaction. We are going to be breaking it all down right here. We're going to talk about what the Fed's decision was on both its statement and the summary of economic projections. You're going to want to hear what we talk about there. We can talk about Chair Powell's remarks, how the market reacted. We're going to give you the big picture takeaway from today's statement and press conference and talk about how that decision affects the outlook for 2024. Folks have already been pretty bullish. I think this meeting is going to make folks even more bullish about 2024. We'll get into that in just a minute. And of course, we'll tell you what to watch out for next because we are always looking forward here on Market Takes, even though it is backward-looking data. So listen, let's get into it. What happened at the Fed meeting? Well, they held rates steady. No one was expecting the Fed to raise rates or cut them. They held steady in line with market expectations. There were some slight changes to the statement that got stock traders especially, but markets overall pretty excited. So small changes, but big reactions from the market are what we saw today. First off, the Fed said recent indicators suggest that growth of economic activity has slowed from its pace in the third quarter. That had previously said recent economic activity expanded at a strong pace. So the Fed essentially saying, we understand economic growth is slowing down. Growth is slowing down. What does growth lead to often? It leads to inflation, right? So they said, that slowed down. Growth has slowed down. Job gains have moderated since earlier this year, but remain strong, and the unemployment rate has remained low. Another change, inflation has eased over the past year, but remains elevated. At their statement, at their meeting last month in November, they just said inflation remains elevated. Now they're saying inflation has eased. It does remain elevated. Yeah. Last change to the statement. Again, small changes, but big meanings, especially for the markets. They had previously said in determining the extent of additional policy firming, blah, blah, blah. Now they've added in determining the extent of any policy firming, right? That one word, any, it's a little thing, but it sends a signal to investors, sends a signal to markets that the Fed is not contemplating rate hikes anymore. Rate hikes are off the table. I got a note from my man Lou Breen. He says that this adds an element of uncertainty to future moves. Kind of the Fed saying, previously, coming into this meeting, the Fed had been saying we're only thinking about raising rates. We're only thinking about rate hikes. We're only thinking about making the economy tighter, choking off growth, slowing things down. Now they're saying, well, we're not sure about any rate changes. We're not sure about any of those things we're going to do. My man Tom Simons over at Jefferies had a great quote. He's the U.S. economist over there. He said the press conference and the Fed, and this was the Fed signaling the end of the rate hiking cycle. That's definitely how markets took it. So we're going to get into all that, but that was what we heard from the Fed in its statement. Let's talk about the summary of economic projections because that was also big. A big thing and a big change in terms of the economic expectations was the increase in GDP expectations. The Fed now says that it expects GDP to rise 2.6% this year, raising their GDP forecast from their last meeting. But importantly, this 2.6% expected GDP growth for this year is more than 6 times what the Fed had predicted in March. That's 9 months ago. So in 9 months' time, the Fed has said, we expect the economy to grow more and more and more. Now they're saying, we expect the economy to grow 6 times faster than we did in March. That's huge. That is a significant increase. March, they're only expecting 0.4% growth. That's basically barely avoiding an inflation. Now we're saying 2.6% above trend growth. What trend growth means is just basically all things being equal. If nothing happened, if there were no stimulus, if there weren't strong consumers buying, if none of these things were happening, if inflation wasn't going on, we expect the U.S. economy to grow around 2.5%. Well, the Fed is saying now not only will we not grow 0.4%, which is just barely avoiding a recession, just barely getting by without falling into negative growth, aka contraction, aka recession, we think the economy is going to grow faster than trend, have a solid, a historically strong growth year That was a big change from what they've been saying most of the year, and an even bigger change, not a bigger change, but an even more notable change from their summary of economic projections in September. That's big. They cut PCE inflation expectations to 2.8% and 2.4% next year. That's down from 3.3%, basically saying we expect inflation to be closer to our 2% target. All of those things telling investors the Fed believes the economy is strong, the Fed believes the economy is going to hold up, it believes inflation is going to come down, and in investors' minds at least, the Fed's going to start cutting rates. Because as Chair Jerome Powell said at this press conference, we want to start cutting rates before inflation gets to our 2% target. So what they've signaled right here, at least what investors are picking up on and why you're seeing the moves in the market that we're going to talk about in just a moment, is that the Fed has signaled inflation's coming towards our 2% target. Chair Powell said we want to start cutting rates before inflation gets to our 2% target so we're not doing too much damage or overly restricting the economy. And that's why the markets are so excited, because rate cuts means you want to get out in front of rate cuts is what investors are thinking, because once the Fed cuts rates, well, that's when all the stuff happens. You're seeing the economy grow and all those things. But you want to buy stocks before that, because once that actually happens, well, the trade's already happened and you missed the trade. So what the Fed is signaling here is they're potentially going to start doing these things, going to start cutting rates, going to start loosening up the economy. That will allow for that growth. But once that happens, well, investors have already missed the boat. So you want to start buying it now, and at least that's the thinking, and that's why you're seeing a lot of the moves we are seeing on the stock market. Let's throw up here the dot plot in the Fed's summary of economic projections, and it may be a little confusing what you're looking at here, but I'll break it down for you really quickly. All of the dots are where the Fed officials, everyone on the FOMC, there's 19 of them, predicts that policy rates will be next year. So 2023 is locked in. They're not going to move. They didn't move today, and today was the last meeting of the year, so that's why they're all on the same line. 2024, that's the big one. And you see, last in September, those dots were much higher. There was even a dot above 6%. Some folks thought they might raise rates a couple times. You're seeing only 2 people expecting that policy will stay the same as it is now. All other 17 members are predicting that rates are going to be cut. And you even got one person predicting that rates are going to be cut below 4%. That's 150 basis points of cuts. That's basically 6 different cuts, if my math's correct, 7 different cuts, excuse me, my math was not correct, coming next year. That's more than the overall Fed is pricing in. But you've got one member of the FOMC. This isn't just, some Joe Lunchbox economist. This is someone on the Fed predicting that they're going to do 150 basis points of rate cuts next year. That is a big deal, and the market is really reacting to that. And then you see 2025 even lower. And so all of these projections are lower than they were in September. The Fed is signaling we are likely to cut rates next year. We expect to cut rates next year. And you've got one official saying we expect to cut rates as many as 7 times. You've got multiple officials predicting 4, 5, potentially, well, no one's predicting 6, but you've got multiple officials predicting 3, 4, 5 rate cuts. That's a big deal for the market. And this chart just really illustrating, again, the Fed's saying to the market, we anticipate these rate cuts that you all are pricing in by what you're doing in the stock and bond markets. We anticipate those are coming, and the markets are reacting. And we really see it in the Fed funds futures market. I'm looking at that right now. You're seeing right now for March, that is the Fed's second meeting, you've got more than a 75% chance, or right at a 75% chance of a rate cut in March. That is significant. Actually, nope. The futures market is always moving. 78% chance now of a rate cut in March. And when you look out to December, well, the market is pricing in significant rate cuts, at least 5, possibly 6 rate cuts for next year. That's more than the average Fed member is predicting, but that is significant. And we're seeing the markets really run with this. We'll get into just what that is in a moment. This is basically the market seeing the Fed saying, yes, we are ready to cut rates. And when the Fed cuts rates, historically, stock prices go up because businesses get that economic exuberance, right? You want to buy things because you think rates are going to keep coming down. You think rates are going to get lower. It unleashes the economy, and that's a good thing for the stock market, and that's why folks are so excited. Not only are we seeing a high percentage chance or high percentage likelihood that rates get cut by the end of the year, when you look at the Fed funds futures market, there is a 0% chance that rates will be where they are right now by the end of the year. No one in the market is betting that rates are going to stay where they are, not even raise from here. There's no one betting that rates are going to stay where they are. There is a 0.1% chance of only 1 cut. There is a 0.8% likelihood of 2 cuts. So investors are saying, We think the Fed is going to cut, and not only going to cut once, they're not going to cut twice, they're not going to cut 3 times, they're going to cut 4, 5, 6 times next year. That's going to really give the economy a tailwind, a boost to especially the stock market. The real economy we'll see, but the idea is this is going to give a real boost to the stock market, push those stock prices higher, those bond prices higher, those bond yields lower. And that's what you're seeing from investors. Let's talk about the press conference really quickly. The biggest takeaway for me was what Powell said. He reiterated that strong growth appears to be moderating, inflation appears to be slowing down, and he said, as he has said, these are the things that we want to see. He also said inflation's not where we want it right now, but he made clear that what he's seeing in the markets and what he's seeing from the economic data is what the Fed wants to see. When he talked about dialing back policy restraint, that's his words, that just means cutting rates, right? The quick, simple way to do that is cutting rates. Powell said, quote, when to do that begins coming into view. So when to dial back policy restraint is beginning to come into view, as in we're starting to think about cutting rates. And the market really took that as we're doing this, rates are getting cut, and they're getting cut by the second meeting of the year. Powell said inflation keeps coming down, so far so good. He also talked about this worry that inflation, this last mile, right? You hear a lot about that, as in getting inflation down from 3% to 2%, and getting inflation down from 4%, where it was just a couple months ago, to 2%. Folks have been saying that'll be the hardest part. Well, Powell said, we kind of assume that things will get harder from here, but so far we haven't seen it. So far, inflation just keeps coming down, and as long as inflation's coming down, the Fed can cut those rates, and that should unleash the economy. At least, again, that's what investors are thinking. One big thing, the biggest surprise for me that I heard from Jerome Powell at this press conference was what he said about financial conditions. If you remember a couple months ago, and I remember because Mary Daly had a direct conversation with me, Fed Chair Mary Daly, San Francisco Fed President Mary Daly, looked me in the eyes, and she said, with financial conditions being as tight as they are, that's really influencing our thinking. That's telling us that we may not need to do as much work. We may need to alter what we were going to do. We may not need to raise rates as much. Well, now Fed Chair Jerome Powell comes out and says, well, about financial conditions, financial conditions, whatever. We're not worried about that. We're watching them, we're monitoring, but financial conditions are going to do what they're going to do. That's a diametrically opposed approach to where Powell was, to where FOMC members like San Francisco Fed President Mary Daly was, to where lots of folks were when they were saying financial conditions so tight. Oh man, we can't raise rates with financial conditions this tight. Now that financial conditions are significantly looser than where they were a couple months ago and a few months ago, now they're saying, well, financial conditions aren't important. And that tells you where the Fed's bias is right now. It looks like to investors, the Fed's bias is towards cutting rates. That was big. We're going to get into a little bit more on financial conditions in just a minute. Listen, the big picture from this meeting was the market is predicting Fed rate cuts, and the Fed said, you guys go ahead and do your thing. If they were going to push back on that idea, today would have been the day to do it. They did not. They very clearly chose not to do that, and you see it in the market reaction. Let's get to the market reaction right now. I want to throw up on your screen right now what we're seeing from the markets. And as you see right there, the Dow going up about 0.62%. We are getting very close to Dow 37,000. Might be time to party, y'all. Get ready. We're also getting close to S&P 500, 5,000. Couple folks like Bank of America are predicting that we're going to see that in 2024. The NASDAQ also up. So just all three of the indexes up for the day. The big action, in my opinion, is in the bond market. You're seeing that 2-year note. That's the one most closely tied to expectations for what the Fed's going to do. That is down 23 basis points. You see it just falling off a cliff right there, right around the time the Fed met at 2 o'clock. Pew! Just kind of like falls off a cliff there. And that really was true across the board for all these treasuries. You see the 10-year down like that, the 7-year, even the 30-year, which is most tied to long-term expectations of the economy, that just really diving down 10 basis points for the day. You see similar action in what's going on with the dollar. You see the euro up big, which means the dollar is down big. Look at the WSJ dollar index, doing about the same thing as those bond yields, right? That's what's happening. Big thing I want to talk about, this is interesting too, Bitcoin up 3%. Bitcoin had really jumped up a little while ago. Now it is moving back higher again. It had fallen significantly over the past couple days, but even Bitcoin, which really is generally not all that tied to other assets and what goes on in the economy, well, even it got a big pickup from Fed Chair Powell's press conference. You see right around 2 o'clock in here, you see just a big takeoff for Bitcoin, now up a little over 3%. So really that's what's going on in markets, and this just illustrates what I had talked about before, and that's that investors are excited, they are bullish, they're thinking the Fed's gonna start cutting rates, that's gonna unleash the stock market and push stocks even higher. That's the same thing we've been seeing. Usually you see a bit of a buy the rumors, sell the news, and we could get some of that throughout this tomorrow. You could see a bit of a, usually they call it a relief rally, whatever the opposite of a relief rally is, but markets had been betting the Fed was poised to start cutting rates. The Fed basically confirmed it today with their actions, at least in the eyes of market participants. And you're seeing the markets rise in terms of bond prices and stock prices, bond yields going down. As we know, when bond prices rise, bond yields go down. And so that's what's happening across markets. The 2-year Treasury had its largest one-day decline since March 17th and fell to its lowest since June 1st. So when we talk about the expectations for what the Fed is going to do next, investors have been clear. They're expecting cuts, and they're expecting cuts very soon. Listen, let's talk about financial conditions really quickly because I told you I would, and I want to get into that. According to the Chicago Fed's National Financial Conditions Index, financial conditions are the loosest they have been since February 2022. Now, why is February 2022 important? Because the Fed started raising rates in March 2022. So despite the Fed raising rates by more than 500 basis points to where we are right now, as in, months and months and months of not just rate hikes, but 3 times the average rate hike. We saw that for 4 meetings in a row. We have seen the rate rise to the highest in 22 years. Despite that, right? Despite where we are, financial conditions are now looser than they were in March of 2023 before the Federal Reserve raised rates even once. That tells you, and when Fed Chair Jerome Powell says, we're not worried about financial conditions, and financial conditions are not only loose, they are as loose as they were in February of 2022 before the Fed raised rates once. That tells you that they are on board with what the market is doing, and the market should do some more. And that's exactly what investors are doing right now. Now, what does that all come back to? It all comes back to inflation. Let's throw another chart up here on your screen. We're going to talk about CPI, the Consumer Price Index. And this just shows you, we've been throwing this chart up here for a while. CPI came out this month, it was 3.1%. Still around that 3% level that the Fed wants to see, moving lower, right? Because that's what it all comes down to. You saw inflation get to that high point, 9% in June of 2022, and since then it's really been coming down pretty consistently. There were a couple months where it moved higher, as you see there on the right side of your screen, but now it is again moving lower. And this again just illustrating inflation is doing what the Fed wants it to do, which is move lower, move back towards that 2% target. And it's doing that. Last chart I want to throw up here is so I can give you an idea of what we're talking about when it comes to the Fed, and that is the Fed funds rate. So let's throw that chart up here on your screen right now. And when I tell you this is where we are, the Fed funds rate is higher than it's been since 2001. And yet financial conditions are looser than they were a year ago when that line there up on your screen was just starting to go up, when it was still at 0. That's how loose financial conditions are. So even though the Fed has raised rates to that high level you see up there on your screen, financial conditions are now looser than they were then. The other thing you want to take note of on this chart is what's the thing that seems to always happen when the Fed starts cutting rates? That's that recession, right? Every single time over the past 20 years, as the Fed has cut rates, we've gone into recession. That's a causal correlation, but generally in the other direction. Usually it's because a recession is coming, the Fed starts cutting rates, in order to try and turn away that recession or try to reduce the impact of that recession. And you get that, you get the recession anyway, Fed rate comes down, 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 and then you kind of go from there. Well, the Fed is hoping that won't be the case this time, and I think you and I, regular folks out there, are hoping the same thing, that we don't have to have a recession as this federal funds rate comes down. But this chart just illustrating where we are, where we've come from, and kind of how that interacts with the environment that we've been in. So let's talk about what comes next. We have got the retail sales report out tomorrow. That's going to be big because, again, it is still all about inflation. The Fannie Mac mortgage rate comes out. That's going to be big. You'll want to watch that because as mortgage rates get closer to 7 and further from 8, that could change how the housing market works. We're going to be talking about existing home sales on Wednesday. That's going to be here on December 20th. Market takes, we'll be breaking it down right here. Existing home sales is going to be big this week, next week. You're going to want to watch that because if the housing market starts to take off, if housing prices keep pushing up, if people start buying houses again and you get that demand flow back into housing, that could alter this inflation picture. Right now, we've got a great picture. It seems like prices are coming down, certainly goods prices coming down. Housing prices have been coming down, rent's been coming down, but if you get a push higher in those housing prices, if you get more people back buying, that could be a worrisome sign. So you're gonna wanna watch out for that. Market Takes right here, December 20th. And for more, check out my podcast, WSJ's Take on the Week. We cut through the noise to explain the major business and financial news that move markets. Also, you can make smarter investing decisions. Subscribe wherever you get your podcast. That's out every Sunday morning. Be sure and tune in. Don't sleep on me, y'all. Come on, tune into my podcast. Anyway, that's going to do it for Market Takes. I am Dion, Rabouin, reporter at the Wall Street Journal. We will be right back here on December 20th. Hope you'll be with us when we do it again next time.